Ryan walks into his bank with $45 in his checking account, asks a simple question at the counter, and waits 17 minutes before anyone acknowledges he is standing there. Sarah walks into the same bank with $100,000 in her account, and a branch manager appears within 40 seconds offering her a bottle of water and a private office. David walks into that same bank with $5 million across his accounts, and 3 employees, including the branch president, greet him personally before he reaches the door. Same bank, same building, same employees, 3 completely different human beings receiving 3 completely different levels of service based entirely on their balance. And the differences between how Ryan, Sarah, and David are treated go far beyond who gets a bottle of water and who waits 17 minutes at the counter. The interest rates they are offered, the fees they are charged, the products they are shown, and the financial opportunities available to them are fundamentally different. Banks have always known something that most of their customers do. Not your account balance determines almost everything about how the institution treats your money. Let's run the real math on exactly what being Ryan versus Sarah versus David actually costs and earns across every major banking product and service they each use. Ryan earns $52,000 per year, keeps an average balance of $45 in his checking account, and has been a customer of this bank for 6 years without ever missing a payment. Sarah earns $95,000 per year, keeps $100,000 spread across her checking and savings accounts, and has been a customer of the same bank for 4 years with clean history. David earns $380,000 per year, keeps $5 million across checking, savings, and investment accounts at the bank, and has been a private banking client for 11 years. Here is the first difference: the monthly fee that each of them pays simply for the privilege of keeping their money at this institution every single month of the year. Ryan pays a $12 monthly maintenance fee on his checking account because his average balance falls below the $1,500 minimum required to waive the fee automatically. Over 6 years, Ryan has paid $864 in monthly maintenance fees for the privilege of storing his own money at a bank that earns significantly more from his deposits. Sarah maintains enough balance to waive her monthly fee automatically, paying $0 in maintenance fees across all 4 years of her banking relationship. 158 character. 16. David is a private banking client who not only pays 0 fees but receives a dedicated relationship manager, free wire transfers, and complimentary notary services. The fee structure alone means Ryan pays $144 per year to use basic banking services, while David receives premium concierge-level services at absolutely no charge. Here is the second difference: the interest rate each of them earns on the money they keep in their savings accounts at this exact same financial institution. Ryan's standard savings account earns 0.01% annual interest on his $45 average balance. That produces less than 1 penny of interest income every single year. Sarah's standard savings account also earns 0.01%, but because she has $100,000 deposited, she earns $10 per year while the bank lends her money out at 22% interest. David's private banking relationship qualifies him for a premium savings rate of 4.5% annually, earning $225,000 per year on his $5 million in deposited funds. The bank takes Ryan's $45, lends it to someone else at 7% mortgage rates or 22% credit card rates, and pays Ryan 0.01% for providing the capital to make that loan. David negotiated his 4.5% rate directly with his relationship manager, a rate that is literally never advertised, never offered to walk-in customers, and never posted. The difference between what Ryan earns on savings and what David earns on savings is not a small gap. It is the difference between a penny and $225,000 per year. Here is the third difference: the interest rate each of them is offered when they walk into the same bank and apply for a mortgage on the same $350,000 property. Ryan applies for a mortgage with a 680 credit score, a $45 average checking balance, and no existing investment relationship with the bank. He is offered 7.8% interest. Sarah applies with a 740 credit score, $100,000 in deposits, and a 2-year banking history. She is offered 7.1% interest on the identical $350,000 mortgage amount. David does not apply for a mortgage. His relationship manager calls him proactively to offer a private banking rate of 6.4% before he has even mentioned buying property on a $350,000 mortgage over 30 years. The difference between Ryan's 7.8% rate and David's 6.4% rate is approximately $108,000 in total interest paid over the loan life. Ryan pays $108,000 more than David for borrowing the same amount of money from the same type of institution because his account balance signals different risk to the bank. Here's the fourth difference: what happens when each of them makes a financial mistake, misses a payment, or needs the bank to work with them on an exception request. Ryan overdrafts his account by $12 buying groceries, and the bank charges him a $35 overdraft fee, an annualized interest rate of over 10% on a $12 loan. Sarah calls to dispute a fee she believes was charged in error, waits on hold for 8 minutes, and the representative agrees to waive it as a one-time courtesy gesture. David's relationship manager proactively calls him when an unusual transaction appears, resolves the issue before David even notices, and waives any associated fees. Ryan is paid $420 in overdraft fees over 6 years from 12 separate incidents, each one a $35 charge on a transaction that was typically under $25 in actual overage. Here is the fifth difference: the investment products, wealth management services, and financial planning resources that the bank makes available to each of them. Ryan is offered a standard savings account, a basic credit card with 22% APR, and occasional promotions for products that generate fee revenue for the bank primarily. Sarah is offered a mid-tier investment account, a rewards credit card with better terms, and occasional calls from a financial advisor trying to sell managed funds. David receives access to private equity deals, pre-IPO investment opportunities, tax optimization strategies, estate planning services, and exclusive lending products. The investment opportunities available to David: private equity, hedge funds, pre-IPO shares are legally restricted to accredited investors with over $1 million in assets. This means the investments with the highest historical returns are legally only available to people who already have significant wealth, making the wealth gap structural. David does not just receive better service because he has more money. He receives access to better financial products that make it structurally easier to accumulate more. Here is the total cost calculation across all 5 differences when you add up what Ryan pays extra and what David receives extra over a 10-year banking relationship. Ryan pays $1,440 in maintenance fees, $420 in overdraft fees, $108,000 more in mortgage interest, and earns essentially zero in savings interest over the 10-year period. David pays zero in fees, earns $2,250,000 in savings interest at his negotiated rate, saves $108,000 on his mortgage rate, and accesses investment returns unavailable to Ryan. The total financial gap between Ryan's banking experience and David's banking experience over 10 years exceeds $2,500,000 from the same type of institution and services. This gap did not happen because Ryan made bad financial decisions. It happened because the banking system is explicitly designed to reward existing wealth with more wealth. Now let's be completely honest about what Ryan can actually do about this, because understanding the problem is only valuable if it leads to actionable change in behavior. The first move Ryan can make today is eliminating the monthly maintenance fee by switching to a credit union or online bank that charges zero fees, regardless of balance. Credit unions are member-owned nonprofits that return profits to members through lower fees, better rates, and higher savings yields than traditional commercial banks. Online banks like high-yield savings institutions currently offer 4% to 5% annual interest on savings, the same rate David negotiated privately at his traditional bank. Ryan moving his $45 to a high-yield savings account does not change the interest income meaningfully today, but establishing the habit and account positions him for growth. The second move is building credit score aggressively, because a 680 credit score costs Ryan more on every loan, mortgage, and credit product he will use over his lifetime. The difference between a 680 and a 760 credit score on a $350,000 mortgage is approximately $54,000 to $108,000 in total interest paid over 30 years of payments. Paying credit cards in full monthly, keeping utilization below 10%, and never missing a payment costs nothing and produces compounding credit score improvement over time. The third move is understanding that the best banking relationship is not one bank. It is the combination of institutions that offers the best rate for each specific product. Checking account at a credit union with zero fees. High-yield savings at an online bank for deposits. Mortgage shopped across at least 3 lenders for the best rate. Ryan does not need $5 million to access better banking terms. He needs the knowledge that the terms he is being offered are not the only terms available to someone like him. David did not start with $5 million. He started somewhere, built his balance over time, and negotiated better terms as his position improved with each passing year. The banking system rewards wealth with access and punishes the absence of wealth with fees. Understanding this mechanism is the first step towards stopping the cycle. Ryan, Sarah, and David all use the same type of institution for the same basic financial functions, but the institution treats each of them as a fundamentally different customer. The next time your bank tells you there is nothing they can do about a fee or a rate, remember that David's relationship manager called him to offer a better rate proactively. Ask your bank for the best rate available, compare it to at least 2 competitors, and move the products where the gap is largest because the bank will not close it for you. So the next time you walk into your bank with whatever balance you currently have, ask yourself one question: am I being offered the best available terms or the default ones? Because the answer to that question determines whether your banking relationship is working for you or whether you are subsidizing the premium experience of someone like David. 169 character.